Investing in a complex world or investing successfully in a complex world. Well, if the world was a simple place, dynamic fund ratings alone would certainly solve all of your problems. But the world is certainly not a simple place. It's actually very complex, but also very dynamic, with a huge amount of change going on very quickly. So your consistently successful investing is highly unlikely to be based on one idea or derived from one discipline. Take our dynamic fund ratings. Those are based on my momentum investing, proven in many research papers which span decades, and those papers in turn analysed data over many more decades and explored vast range of asset classes around the globe. And this research involved some not too complex maths and an open mind. Now, that would be all that you needed if you were if we were all perfectly mentally balanced, if we were all well organised and never distracted, and if the markets behave themselves. A little bit of volatility, but nothing to scare the horses. But the world, whether you're investing or otherwise, is not so straightforward, and the tools don't come in a nice, neat red box from a DIY store. So to be successful, you've got to align your plans with how the world really works, and dynamic fund ratings are just a start in that process. So your investing plan also has to take into account these real world factors. Firstly, that you and all of us are not so mentally well balanced, or at least not so mentally well balanced as we all think we are. Also, few people excel at personal organisation, however well they might manage their working environment. And our lives are full of day-to-day distractions, starting with the family and our day job, let alone the swirling, fairly negative commentary and coverage in the media. And markets are not consistently predictable in any practically useful way. Market risks are much greater and less predictable than the maths would have you believe. Markets go down and stay down in ways which can destroy your life plans. And our dynamic fund ratings provide a very high probability of success over longer periods, but are certainly not going to succeed over all shorter periods. Now, you're not going to achieve perfection by allowing for all of the above in your investment plan, but you're certainly going to move the odds of success very strongly in your favour. Now, on another occasion, I'll expand on all of those, but the good news is I'm not going to expand on all of those today. But you should invest some time working on each of these factors and the solutions which work for you in particular, because the way in which you tackle each of those factors is not necessarily going to be the way which someone else will, but you could both be successful with your alternative approaches. As Abraham Lincoln said, give me 6 hours to chop down a tree and I'll spend the first 4 sharpening the axe. Your investing success isn't derived from being fast or clever, it's about being smart. And being smart means thinking first, thinking slowly and acting calmly. So that clear plan is going to enable you to think more clearly, which in turn will improve the quality and consistency both of your decisions and of your results. And also the elements of that plan will then become habits, and those habits will feel automatic and much less stressful. And talking about stress, uncertainty is very mentally demanding. And when you're investing, you literally buy uncertainty. And a vital objective of your plan must be to reduce that mental stress. And the rules and guides in your plan are a pre-commitment that should avoid you having to make quick decisions under stress, because that would be a recipe for very bad decisions. Yes, I know this is basic stuff, but it continually needs repeating. Practice, 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 and good habits and outstanding results will follow. But when will those outstanding results follow? And herein lies one of those real world problems, which comes within the first point I mentioned above. We're not so mentally well balanced. And the problem is one of time perspective, impatience, if you like. And interestingly, one Harvard professor studied the issue of upward mobility over 50 years. And he wondered why some people moved from lower socioeconomic classes to higher ones and some didn't. Why did some literally move from rags to riches? And his view was that the overwhelmingly most important factor was having a time perspective. For the poorest people, it's understandable that their focus is in hours, the next meal, and where it will come from. Those who escape this trap are, as this professor would say, also focused on the years ahead. And they might escape the poverty trap by, for example, sheer hard work or investing in further education, simply because they are focused on the years ahead. Now, many of you listening might have personally experienced this or seen this in others. I certainly have. Escaping poverty is not accidental, short of you winning the lottery or robbing a bank. Successful people are intensely focused on the future being measured in years. And the very act of thinking long term sharpens your perspective and dramatically improves your short-term decision making as well. So when will outstanding results follow? To go back to the original point, it's over years. There will be bumps in the road, and we'll certainly be talking more on that later today. But for now, just to paraphrase Benjamin Disraeli, beware of trying to be a great investor in a hurry. Now, last but not least on this behavioural stuff, how about just being lucky? Much of what happens in our lives is a combination of skill and luck, albeit a different balance depending on the precise circumstances. For example, sports teams are fun and a lot less predictable because the most skillful teams don't always win. There's a lot of random stuff going on within the game, and luck plays a significant role, and you can see that every weekend if you watch sports on TV, football, rugby and cricket, or go to live matches. And then at the other end of the scale, when you go and see a dentist, it's skill that's the more overwhelming factor which dictates the outcome. You're highly unlikely to lose all of your teeth randomly and unexpectedly as you walk out of the dentist's. On every occasion before I go to the dentist, I can make a confident prediction about the outcome because the outcome is dictated by skill. But unfortunately, on every occasion before I go to a football match, I can't make such a confident prediction because luck plays such a large role. And it's precisely because of this that the bookies make so much money. Now, somewhere in between the financial markets and your interaction with them, there are a vast and complex web of matters which impact markets, and whether and to what extent you or I might be impacted by them is largely a matter of luck. But what isn't a matter of luck is how we deal with random, unpredictable events. More importantly, how we plan to deal with those random and unpredictable events. Successful investors organize their investments so that they're in a position to enjoy the good luck and avoid or limit the impact of bad luck. They know that very bad things can happen over which they have absolutely no control and or for which there's absolutely no precedent. But they know they can limit the impact of them when they occur. Now, a great example of someone on the face of it successful but who got this very badly wrong was Alan Greenspan, former chairman of the US Federal Reserve. Before a US Senate committee, he apologized for not foreseeing the 2008 crisis. He said because it never happened before. And that's the problem with history, because history is just a sample of what might happen. And history then can blind you to the possibility of more extreme events which are beyond prior experience. And for many like Alan Greenspan, that's exactly what happened in the lead up to 2008. No matter how carefully you make your plan, you cannot know precisely how this will be impacted by such events, those sorts of unforeseeable events which are just luck or really bad luck. What successful people, lucky people do is cut losses, whether that's in investing or jobs or relationships or any other aspect of life. You live to fight another day. Interestingly, according to two psychiatrists, Block and I think is it Sorrenti or Correnti? Do correct me if I'm wrong. Who wrote a book called Psyche, Sex and Stocks. The inability to cut losses is one of the traits of the born loser. That's their words, and that is harsh words from them, but I think they should be taken on board.